What are some of the other entity structure mistakes that people make?
I also see people try and, open up too many LLCs that they don't really need. And then if you open up too many LLCs and you can't stay compliant, now you're in a situation where, you're not getting any legal protection. Trying to do too much could get you in trouble. The IRS is significantly less nasty to taxpayers when you have proof of doing something the right way.
Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan Bakey, live in Nashville. And today we have a returning guest, Billy Withers, in Nashville with us today. Billy, how are you doing?
I'm doing great. Thank you for having me. I'm pumped to talk about what we have today.
So talk a little bit about some mistakes that people make when they form partnerships, specifically we call them surprise partnerships, where they don't know that they actually need to file a tax return.
Where do you even start? I think the operating agreement is a very important one. Kind of the building blocks of the partnership is open the EIN, open the LLC, get the EIN, open the bank account. But you should really have an operating agreement as well if anybody more than yourself. And it's vital to kind of lay out everything that you can think of, how the work's going to be divided, how the cash is going to flow, things like that. Outside of that, something I often see, get a lot of questions on is, my partner and I both want to use the short-term rental loophole, and how do we navigate that? You could even lay that out in an operating agreement. And then from there, you got to understand that if you want to use the 100 hours and more than anyone else test of the short-term rental loophole, that means that only one of you, because you both can't be more than anyone else, right, can take advantage of the short-term rental loophole. If you can both find a way to work 500 hours in the partnerships, and I have worked with some large, 20, 30 unit short-term rental partnerships that can achieve that, then you guys both would qualify for the short-term rental loophole. But if it's, your first property and one of you is doing more management than the other, that's going to be the person entitled to the non-passive depreciation that we like about short-term rentals.
So this is also confusing too, because people think that just because they're not self-managing it, that they don't get to benefit from it at all. But they do. Like, one partner is going to get to take that depreciation against their other rental income, right? But one partner gets to take it against their W-2.
Exactly. That's the other key point for sure. Because, if you're, especially, if that's your arrangement, why did you get a partnership? Because, I have time and the other person has money. That money person may need the passive deductions, right, and so they still get a benefit. So it, always pays to work with, tax strategy advisors just like yourself, because you're going to be able to point out not only how it benefits both partners, but then apply those to each partner's individual unique situation.
That's actually a good point that I don't know why I haven't thought of that yet. Is typically it's one person has a lot of money, one person has the time and the experience to do it.
Yeah.
But it's the person that has a lot of money that typically needs the write-offs.
Yeah, exactly. Yeah, if they're looking to get it against their W-2 income, they may have to take down their own property or something else. But like I said, if they have a rental portfolio, they'll still be able to realize the deductions. I was actually working with a client the other day where they actually had two money guys, but everybody has a sizable enough real estate portfolio that they're going to benefit from a cost segregation study on a short-term rental in a partnership. So the hustler is going to be able to get the active non-passive deductions, and the other two investors are going to be able to use the passive deduction.
What are some of the things that are commonly missed in the operating agreement?
I read an operating agreement the other day that was this LLC will be a S corporation, which, as we know, no rentals in an S corp, and so that was a little scary, because basically if you execute on the agreement, now you're in compliance with the agreement and your LLC is an S corp, but you're screwed on the tax benefits. Vice versa, you could be out of compliance with your operating agreement. That could tear the whole thing down from a legal liability standpoint. But hey, at least you get some tax deductions. So just really reading through all the pages. I know it's tedious. Reading through everything, making sure that your intentions are there. Trying to think of all the pitfalls. What if somebody wants to sell their shares in the LLC? What if somebody can't agree on whether you're continuing to sell, maintain the property or sell it in a 1031, something like that? Try and spell out as much as you can. Try and define as many terms as you can. Get it all laid out on paper, and then most importantly, sign it. That's another one. I get unsigned operating agreements all the time. I don't know if it's the final draft. I don't know if everybody agreed to it, et cetera, et cetera. You got to be, you pay attorneys a lot of money to put those protections in place, and but the onus is on you to execute and make sure that you're protecting yourself ultimately at the end of the day, and the operating agreement is going to be a pivotal tool for that.
What are some of the other entity structure mistakes that people make?
So rentals in an S corp is a problem because
Real quick, guys, if you could think about how you found this podcast, maybe it was on Facebook, Instagram, maybe somebody shared it with you. I don't run ads for the show or have sponsorships, so the only way this grows is through word of mouth. If this was valuable for you in any way, the only ask that I can make is that you share it with somebody else. Pass it on to the next person whose investing journey or business can be changed by listening to the show. Much love, guys, and let's get into the episode.
rentals in an S corp is a problem because it does three things. You lose stepped up basis on death because the property stays within the S corp. If you do a refinance and you want to take the property out, you could have a capital gain on the distribution of the property once you get the loan on it. And then lastly, your basis can't go below zero. So if you take a bunch of depreciation, then do a refinance and give the money back to any of the in this case shareholders, those people could pay capital gains on a refinance, which is obviously it's contra to everything we know about real estate investing. I also see people try and open up too many LLCs that they don't really need. Complex corporate structures obviously have a liability layer in place, but you got to remember, if your property's leveraged, the bank owns a piece of it, you have insurance, things like that. And then if you open up too many LLCs and you can't stay compliant, now you're in a situation where you're not getting any legal protection because you forgot about it, ignored it, et cetera, et cetera. So trying to do too much could get you in trouble as well. So
what's the number one mistake that short-term rental investors make on their first property?
Oftentimes not working with a tax strategist soon enough. They may be thinking, going it alone, thinking that they're going to qualify for a bunch of depreciation deductions that they don't qualify for because they didn't get it listed in time. Things like that. I always tell prospective clients, if you have one short-term rental, working with a tax strategist is going to pay off pretty much immediately, versus on the long-term rental portfolios, usually it doesn't make sense till 3 or 4 properties. So I would say, outside of the normal business operations of open a LLC, get your EIN, open your bank account, and then make sure you stick to that structure. The second most common thing is probably, tax strategy.
So you mentioned also about the one partner could take the loss against their income and the other one doesn't. But a little bit more about the material participation rules and kind of those grouping elections. So can you explain how the tests work when you have multiple properties?
Yeah, so the IRS says that you are allowed to group short-term rentals that have a commonality, whether that's common control, common business operations, things like that. So if you're reporting separate activities in terms of, 123 Main Street is one property in my LLC and 125 Main Street is another property in my LLC, but I run them together, you can make a grouping election to treat those as, one activity. But most oftentimes, elections need to be made in the first year that the operation is in place. And if you miss that, you could be missing out on potential deductions down the line. I had a client who came to us and said, well, we grouped everything together because we were running it together. And I said, well, where's the elections on your tax return? So usually at the back of the tax return, you need to have your de minimis safe harbor election, and you need to have any appropriate grouping elections in place. So definitely review those before you file any tax returns in the first year of activity.
What's scary is I heard the IRS doesn't even have those on file.
Interesting.
Like when you go to pull people's transcripts, you don't know if they made the grouping election or not.
Yeah, no, I don't know enough about the IRS computer system to understand if, how they know that or not when they go to do their audits. So I think, the best thing you could do is make sure you save those copies of the tax returns, not in your accountant's portal, but on your files, back them up in 3 different places so that you never have to worry about it. Because you need to be able to, the IRS is significantly less nasty to taxpayers when you have proof of doing something the right way.
Yeah, talk about material participation and when can you not create a time log.
So one of my favorite quips about the material participation time log is,
Hey guys, just wanted to interrupt the podcast to let you know that if you enjoy the podcast and the content that's in it, you would love my Tax Strategy Academy. This is going to give you the framework for developing all your tax plans for the entire year. Whether you're a long-term rental, short-term rental investor, you're going to get a one-on-one call with me to map out your tax plan, and you're going to get access to weekly office hours where you can come and ask your personal questions. So if you're interested in learning more, go check out the link in the show notes below. And now back to the show.
one of my favorite quips about the material participation time log is Google tracks everything. They know where you are at all times. So if you're ever not sure about, where was I when, you just do a Google search on how to, see your location history. And so, for example, the first year that I put a car in service, I didn't do a great job at tracking my miles. I didn't take my own advice. But I was able to look at on Google every single mile and tracked what was business and personal. Thankfully, it was only over a couple weeks. And so it was a really powerful way to say, okay, Google has my calendar, so they know where I was where and talking to whom, and then Google also know where I physically was. So that really helps out if you have to recreate a material participation log. I obviously never recommend doing that more than 1 year. Basically, it's tax time right now, and so if you're looking back at 2023 and going, hey, I forgot my material participation log, I would say definitely use the Google Calendar and Google Location method, but definitely going forward, just keep that contemporaneous log because that's going to keep you out of the most hot water.
And with keeping financials and records, bookkeeping is probably one of the biggest headaches that investors have. What are your recommendations to alleviate those headaches? Are there recommendations other than just hiring a bookkeeper?
Well, so if you hire a bookkeeper, if you hire AI, if you try and do it yourself, you got to remember the secret sauce is in the balance sheet. Mm-hmm. At the end of the day, how much property, how much do you have? How much depreciation has it claimed? If there's $1,000 in your bank account on December 31st, do your books and records reflect that? It's really, at the end of the day, the profit and loss is going to be, how much money I brought in and how much money I expensed. But at the end of the day, when those balances all line up on the balance sheet, it's a snapshot of your business. And so that if I have a bank account and it's not on my balance sheet, I probably missed something in my books. If I bought 2 properties, I only have 1 property here, I missed something in my books. So whether you're hiring a bookkeeper, doing it yourself, you're going to be able to kind of keep tabs on everything and say, hey, this doesn't look right now. I need, real help.
What are the biggest mistakes that real estate investors make from a tax planning perspective, other than not doing tax planning?
So I always say the most commonly missed deduction is the one that isn't tracked. So that just goes to the power of bookkeeping and having a system that allows you to say, I only use this checking account. I only use this credit card or this set of credit cards for these different purposes. And last point on that is, I may use these credit cards and debit cards, but I don't stay on top of my transactions at a frequent enough clip to go, I forgot about this one little thing, or, I was not diligent about keeping track of my receipts. So really, you're getting into real estate investing because you want to be financially free or, earn yourself some, time freedom as well down the line when you can maybe retire from your W-2 job. But it really is a business, and you get the most deductions when you treat it as a business. And the people who don't are significantly less successful than the people who know every cent they spend, whether or not it's deductible or not, or how deductible it is, because there's always gray area. We can always do so much more when we have more information compared to less. And a part of that's just, being organized and being on top of things.
Awesome. Where can listeners of the podcast find you?
So on Instagram and LinkedIn at Billy Withers Tax. Otherwise, check out our website, summitats.com.
Awesome. Thanks.